Hello and welcome to the Raise Capital Legally podcast and YouTube channel, where we talk about topics of interest to real estate and syndicators, fund managers, with an opportunity for live questions and answers before we sign off. I'm Krisha Young, co-host and business development director for the firm, and this is attorney Kim Lisa Taylor, the founder of syndicationattorneys.com. Now, before we get started, please note that audio and video from this event will be posted on our podcast platform, YouTube channel, website, and social media, and will be made available to the public. You can go ahead and ask questions at the end of the broadcast by raising your hand or typing in the Q&A. Please note that information discussed during this event is of a general educational nature and should not be construed as legal advice. So today, our topic is Discover the Goldmine of Mobile Home Park Investments. In today's episode, we sit down with Ali Nasir Ali, an eighth-generation real estate investor specializing in manufactured housing facilities, MHPs, and permanent resident parks. With a deep passion for affordable housing solutions, Ali has built his business by acquiring underperforming mobile home parks and transforming them into thriving communities. We'll discuss his investment strategies, evolving landscape of the MHP industry, and why affordable housing remains a resilient asset class in any market condition. Hello. Hi.
Good,
Hi, Kim.
Hi.
good morning,
Ali.
morning, everyone.
Great. Hey, thanks for joining us, Ali. So, you're a client of the firm, and we've had some discussions before that sounded really interesting about some of the experiences you've had. So that's why we invited you to come, because I think this is interesting for our audience, not to just hear how, hey, well, I didn't come from that background, maybe I can't be as successful as Ali, but maybe thinking, forward, right? So maybe I could create something like this that my future generations could benefit from. And so specifically, you said you're an eighth generation real estate investor. What's the story behind your family history in real estate?
Well, good morning, everyone. First of all, thank you, Kim and Krisha, for this opportunity and for asking me to participate. I just want to say I was watching a YouTube video recently and about things that you can do, just much like we do for health, we exercise, we eat right or whatnot. But for business and for building our business, one of the things that was mentioned in one of the recent podcasts I watched was doing masterminds and participating in podcasts and being around like-minded people. So thank you for the mindsets that you've provided, the podcasts that you provide. I've learned, I've benefited. I'm looking forward to getting back to, participating in real time or live in those events as soon as I can. I feel guilty every time I miss one. But in any case, I think it's a great service, and thank you for that. So the story behind the family history, I've traced it as far back as I can, and to keep this brief.
Oh,
Excuse
we've
me.
lost your audio. There you
Hopefully
go.
you can hear me. Okay, sorry
Yeah,
about that.
you're
My
back.
earbud fell off. Uh, Going back to prior to even currency. So my family's originally from India, from Gujarat, which, by the way, just being from that part of the country, they, for better or worse, they have a caste system, and we were typically from what would be the business or the merchant caste. So we were always in business, always in real estate, as far back as I can trace. And before currency, even when the barter system was in play, or that was the way of doing things, my understanding is that we didn't have anything to barter. We didn't have any product or service other than our land, which was used to be the bazaar where everybody else brought their goods. And
Wow.
so, right, so we had the flea market or the swap market, the swap, meet of the time, whatever you want to call it, the bazaar, and everybody would bring their goods in exchange, and that's what we would get in trade, is in exchange for using our land, and where everybody would congregate, we would get rice or grains or whatever. And so it's kind of an interesting story going back to those times. My father is one of those one in a billion type stories, and he during the partition, and I'll make this brief, but during the partition of when the country India split into multiple countries, particularly India and Pakistan, my father must have been 4 years old or something, and they ended up migrating to Karachi, Pakistan, and basically lost all the wealth. So what so he grew up in poverty, but what he didn't lose was the knowledge and the ambition and the determination that was passed, I think, through the family, through what the stories he had heard, and he carried very closely. By 12, 13, he was out doing entrepreneurial things. By 19, I think he did his first creative real estate deal, expanding a bazaar into twofold, really, taking a bazaar that was in Karachi and making it twice as large just simply by locking a lease option type deal on the property next door.
Oh,
Um,
that's fantastic.
yeah. So fast forward, this guy goes through from Karachi to from the worst parts of the ghetto of that city to the best parts, and then to the state capital, the country's capital, and then on to London, and where we were living when I was born, and then on to finally to New York. Oh, before even London, by the way, he tells his wife to be my mother that we're going to have 5 kids. We're going to live in the West, and they're going to have the opportunity to go to UC Berkeley. For some reason, UC Berkeley, that was his thing. So by 74, he gets to New York. By 77, he buys a brand new wagon from whatever he was able to muster up during doing business in New York. And I don't want to go into all those details, but the point is that he buys a station wagon and a trailer, a travel trailer, an old one, a very modest one. But we take it, and it was the best journey of my life. I still remember that. I must have been 7, 8 years old. And we took this 3-month summer journey, if you would, traveling the country in that trailer and that wagon, seeing most states, most cities, most landmarks that people don't even think about oftentimes. Um, but anyway, that was quite a journey. And we ended up in Orange County at the time. This was 77. And we stayed in that trailer for another 3 months when we first landed. Within 4 years, this guy had up to 100 single family homes in Orange County.
Wow.
With very limited resources. And I can go into that some other time, but very limited resources. He was just creative. And when you have limited resources, of course, he was leveraged quite a bit. But the point is in that after that, the 79, 80, I was a young kid, obviously, but the economy took a incredible dive. The inflation was through the roof, as you may know. Interest rates were up, I think, hovering around 20%. So we talk about interest rates high now.
Mhm.
20% interest rates, and that house, that 100 plus portfolio of homes came tumbling down excuse me, like a deck of cards, because it was still quite leveraged at the time. People couldn't make their rent payments or mortgage payments on the wraparound deals that he had done. And so it all came tumbling down, and that led to basically him selling off, giving away, giving back to the bank, whatever he could do. And what he was left with was enough to put a down payment on an RV park, because through that journey and that stay for 3 months, he actually became fond of the business, understood the business model, and put the down payment on an RV park. And I'm getting into the tangent, but that's where the journey really starts into uh, investing in mobile home parks, because we saw uh, that that business firsthand. We bought our first park. I say we because I was 12 or 13 years old at the time. It was a KOA. You guys have probably heard of KOAs, or maybe have stayed at a
Sure.
KOA.
Yeah.
And so, yes, it was a KOA campground, and the previous owner's name was Joe. And I decided that day when we bought it, July 9th, 1981, that I was the new KOA Joe. And yeah, and then literally changed my name to Joseph, and everybody in middle school and high school knew me as Joe. Everybody at the park knew me as Joe. I think at 12 or 13, Dad said, "Go, go mow the lawn, go clean the restrooms, go, take care of the pool and whatnot." So paid the dues outside. But by 16, I was able to, and thanks to him, I was able to start leasing trailers out, renting trailers, leasing trailers, excuse me, even on a long-term basis, because we discovered very quickly that the RV park was seasonal. The RV business was seasonal. right? So you had your fancy rigs coming in to go see Yosemite, where our park was, near Yosemite and Sequoia National Parks or whatnot, in the summer months, the nice months. But the rest of the time, it was kind of slow. So
Mhm.
we supplemented that with putting in trailers and RVs to have routine income and provide that for construction crews, for lower income families in the area, et cetera, for retirees, et cetera. And that started working really well. We ended up expanding the park to more than double the size. Um, and ran that business as a true family business for, like a typical immigrant family story that you would expect. Everybody was working in it. And we ran that for a solid 10 years. I think we kind of understood the business models well by then, with the parks and whatnot, with the difference between transient and business, and we can talk about that perhaps later, but versus permanent residents, and the benefits of having mobile home parks be really the primary way to go, or having that business be the focal point.
So
So
I heard a
go
common
ahead.
thread here, that your family has come back around from where it started, renting land, basically, to back to we had property and we let it go or had to let it go, and now we're back to the land. So it seems like, you've always made your bed in the land. Not necessarily development, but just, realizing that you can maximize, you can still rent real estate without having to maintain the house.
That's right. That's right. We went full circle, and got away from businesses, going concerns, and focused more on income from land, or income properties. So yes, that's right.
That's right. And what do they say about land? They're not making any more of it, right?
That's it. That's it.
Unless we have some big seismic shift, which I would be excited about with a background as a geologist, but probably not everybody else.
Right.
Or unless we really start developing on Mars.
Well,
Yes.
yeah, that's just going to be hard to get to for a while. Uh, okay, so we kind of, I think we understand that, yeah, you realized, hey, how do we overcome this seasonal obstacle? How do we get more steady income? And that's by putting some mobile homes or some, trailers, RVs, something on the land that you could rent on a more regular basis, and then opening it up into not just the transient vacation rentals, but the other people in the community that needed to live in those places and couldn't necessarily afford to own, I would imagine, in some of those places. Either they're there short term for a construction project, or they're, working in the service industries and they're not able to afford those vacation homes in those areas near Yosemite.
That's
Um,
right.
Really interesting. Um,
Mm.
so then how did you, build on that? Once you started with that first park, did you guys begin to acquire more? Did your dad kind of stay with the park he had and then you took it to the next level? Where did that go?
So thank you. Yeah. So we sold that one after 10 years for, I think it was 3x, and of course enjoyed the livelihood, the income as well from that. But we realized that, hey, this is, we really don't want to be in any business. We would like to avoid being in the rental business of renting homes. I don't want to use the word lazy, but we wanted to make sure that we weren't in any kind of actual business that was management intensive, labor intensive. We wanted to get to where it's either passive or semi-passive. That's always been the goal. And so after selling that first park, the RV park, we bought our first mobile home park. And we just kept buying additional mobile home parks. But the point is that in those parks, we weren't renting homes anymore like we did originally at the RV park. We were just renting spaces. There are times, and this is probably a discussion for later, but there are times where people don't, there's many cases where, and this is one of the reasons why parks stay underutilized, is that residents who need and want the affordable space don't necessarily have the upfront costs to buy a home, to transport it, to set it up, and to be able to rent that space. So we will still purchase homes, set them up. It's all done completely under a separate entity for other reasons, for accounting reasons, legal reasons, and whatnot. But have a separate arm that places homes. But the actual the entity that owns the real estate, the community, would not engage in renting homes. So we had, a separate arm again that would sell homes and maybe even offer financing if when appropriate, and have notes that you could have as an additional profit stream, but that was all a separate business and separate, and not to say long term, right? Those notes might be a shorter term because we're not in the mobile home sales business. We're really in the real estate business, the land business, going back to that. And so Kim, the answer is that we just kept scaling. We initially bought small parks, maybe 30 units, 40 units, 50 units that were clustered close to each other so that we'd have economies of scale and some efficiencies, knowing that we wanted to, and this is for the audience really, knowing that ultimately you want to have density. You want to have at least 50 units in this industry or this niche or more. 100 units would be great, but at least 50 units. And I'm not sure what the benchmark is in other, what other people suggest for apartments and other types of classes. But in this case, you'd want to have at least 50 units, in a community, or at least near each other, to be able to have efficiency. So that's what we started doing. And again, to answer your question, and I'll wrap it up on this, but it's been a journey, right? We started with smaller parks, maybe the one star, one from 1 to 5, 5 being the best and 1 being the least appealing in terms of curb appeal and whatnot. Not necessarily less lucrative, but did I lose you?
No, we're still here.
Okay. Not necessarily less lucrative, just less curb appeal, less overall in terms of amenities and whatnot, and maybe the neighborhoods. But the point is that we went from the 1 and 1.5, maybe 2-star parks and smaller parks to today. I don't necessarily don't need to be in the 4 and 5-star range because those aren't necessarily as appealing or sexy, if I may, in terms of economic returns, because they're very passive, and it's great for investors like the REITs and whatnot. And we have 1 or 2 in that category that are nearly 300 units or more, or around 300 units. But our niche and our focus has become the 2 to 3-star, where there's some upside, and at least ideally 100 units or more. Secondary markets has become, and we've grown into that. So over the time, I've touched probably, I don't know, over 10,000, probably closer to 20,000 units, mostly in California. The model was, at least historically, to acquire underperforming, stabilize, exit, and then trade up and keep trading up, trading up, trading up. And I'm still doing that, but at some point, that model will change depending on your goals. In my goals, in my case, I'll probably
Let's get on
hold
to
some. Yeah.
So, okay, so we understand what got you into the mobile home park industry. And you said something about you primarily invest in secondary markets. So let's explore that a little bit. What do you mean by that? And why do you find those attractive?
I think the secondary markets are ideal, at least in this space, if you can, for small to mid-sized investors. Primary markets, Los Angeles, San Francisco, the Bay Area, or New York and whatnot. Those are just cost prohibitive. They're very difficult to get in terms of the acquisition cost, the regulations, et cetera, et cetera. And primarily, players investing in these major cities, they don't necessarily even need a return. It's not even about the cash flow for them, for the foreseeable future. It's about the long-term game for them, right? So they're not even necessarily concerned about cash flow. It's hard to compete with that. Tertiary markets, pre-pandemic, I wouldn't even consider them. I'm open to it now for reasons we could discuss later, perhaps. But and they're becoming viable more and more. And we just did a deal recently in tertiary market. But I would say that secondary markets are ideal because you have the all the right metrics. You have the population, the demographics, you have the resources, the sources of income for residents in the area. You have the infrastructure when it comes to healthcare and just essentials of life, and you have the right price point to be able to invest in those deals. So I've found that to be the best.
you know, just so the audience understands your mindset, what do you mean by secondary markets and tertiary markets? What would you consider some of those, say, with respect to like Los Angeles?
Okay, so for example, in the greater Southern California area, to me, Bakersfield would be a secondary market. um, maybe San Bernardino area, Riverside County and whatnot, as opposed to, trying to invest right in LA County,
Right.
or in the cities of LA. Yeah. In California, I'm big on California, and I know most people aren't, but other examples would be like Fresno, Sacramento, markets like that, and not necessarily smaller towns like Tulare or Visalia, or where we actually started originally with that KOA. But in even smaller towns, there's so many towns that are 5,000 population, or under 10,000 population. I would consider those definitely as tertiary markets, and the ones to be very careful about as you go.
And why do you say that? Because if something happens and the economy contracts, then those are the suffer, or what is not attractive about the tertiary markets?
Well, again, it used to be, and this is changing. So I wouldn't say I'm not. I want to be clear. I wouldn't say don't do it. I just did one, but historically, there was just seems you have to look at the demographics closely, which I think is not talked about enough. Is there population growth? What's the source of income for the people, for the residents there? Is there a source of income? You know, is there a bank nearby? Is there a hospital nearby? Are there options? A Walmart nearby? I mean, are the essentials there? For folks, and if they're not, if it's not an appealing place, what's the reality of what's the likelihood of the demand and rates increasing over the time, and being able to really fill a community in a market that's unappealing. So that's changing, by the way, and I keep saying that, but two or three thing drivers, since the pandemic. There was a lot of migration, and I think I attended one seminar where a speaker mentioned that there's been a major shift of about 30% of the population since the pandemic. That we're seeing that by 30% of the population is moving from primary markets into secondary and tertiary markets. And that was very interesting, and we've seen this firsthand in California, and it's one of the reasons I've invested in a small town recently. The other thing is, of course, the whole work from home concept, which I know we're kind of regressing a little bit or digressing a little bit on that, but it's still very much a thing. There's many people who have moved permanently and aren't moving back, and I think it's become accepted widespread. So that's also impacting, I think, growth in tertiary markets. Not opposed to it, just like to be a little more careful.
Right. Okay, so you said underperforming, so you're looking for the kind of the ugly parks, right? The ones where the weeds are growing and the roads are kind of potholed, and maybe the parks don't, or the homes themselves don't have the best lot appeal. Is that kind of what you're looking for? Those you can kind
Absolutely.
of like, do you improve them? Do you make them better?
Yeah. So absolutely, that's one of. I mean, those are sexy parts to me, and that's the ugly ducklings are really, of course, one. That's one way that I would define underperforming parks, right? And it's the easiest, right? When you see area for improvement, and with capex, it's a no brainer, much like almost any other asset class. So yes, absolutely. If those are the things, if money can fix a problem, and we know that, hey, you fix these things, there's the demand is there, everything else is there. It's just not appealing otherwise. If that's all you have to do, and it's clear, or one of the key things you have to do, then absolutely. But when I say underperforming, I want to make sure it's not just the physical appearance. It could be related to the financial structure. It could be there's sometimes there's I call it a silver bullet. An opportunity to increase the performance of that park. For example, a city may have a rent control ordinance that is largely favored, and they largely favor the residents, but there may be some language in there that actually speaks to the benefit of landowners, of the community, the property owners. And to be able to kind of extract that language, to be able to get the right support, professional legal help, and use that in your favor, perhaps, to get that park at market rates or close to market rates, and have it start performing as it should. is another example of an underperforming
Is that a
deal.
skill set that you've developed then, is to be able to go in, look at those regs and say, okay, so how can we work this? How can, how can we use this? It's not only going to benefit the community, but benefit us. Is that something you feel like you've learned?
Yeah, I missed the first part of what you
I was
said.
saying, like looking at the regulations and saying, hey, what can we do to fix this? Or, if we have an underperforming park, it has a bunch of vacancies, are we, is there something constraining us? Are you able to work with the local regulators and kind of sort those things out?
Yes. So we're looking at I'm looking at a deal now. It's a portfolio in a city where the city manager, and they don't have a mayor, they have a city manager type model there. The city manager, the deputy city manager in that case was a key member with the park owner of another park, independent of mine, who's already done this in that city where they were able to work together and in fact had a where you typically see, 3%, 5% increase, translating to maybe about $10, I don't know, $10, $15 a month. They had a one-time hit or increase of $145 or so per month in rent. Um, and it was justified by the city, despite the rent control ordinance, by the way. It was accepted by the city and by the residents and all of that in a community, in a joint effort, based on the fact that as community owners, investors, they had the right to enjoy a reasonable a return based on a reasonable cap rate. And yes, and they had the right legal team, they had the right support from the city, and I use that as a case study to say, okay, we have a precedence in this city now. Let me look
Yeah,
at and we happen to have a park in that city already, and so I decided to explore the options for that community as well as started looking at additional deals in that same city because
my
now,
recommendation, Ali, hire those same attorneys. They already
ex-
know how to do it.
done. It's already done. Done. That's the first. And I happen to know that law firm. I already was using them for a couple things, so they were the first call I made.
Yeah, just, that's one of my general rules. Don't train your attorneys. Don't be there first in a particular area, and make sure you get the ones that already know what they're doing, and then you're going to be better off in the long run.
Makes
Um,
sense.
yeah, yeah.
Yeah.
All right. So what about loans? Like, how easy is it to get financing on mobile home parks?
That's funny. I'm glad you brought that up. That to me, yeah, I remember days where it was just that wasn't a thing. Especially in the lower in the smaller parks or unless you were, I don't know, 300 units plus, maybe there was some financing. But I remember as growing up, late 80s, early 90s, seeing only seller finance deals, carries and whatnot, and really not seeing much of the larger banks and whatnot. That's changed. That's changed. Now you have major banks in the game. Wells Fargo, I think GE, when they were around and doing it, they did quite a few deals. For example, they had a branch that did financing for parks. But you have large groups like that, and then you have the major banks like Wells Fargo and Capital One and whatnot. And then you have a number of other options now in conventional financing, whereas it didn't exist before. And I think now you can even get it for RV. I know you can also get RV park financing also, which was even greater risk because of the transient nature of that business, the hospitality and the lack of
Right.
stability.
Is it,
But
is their mobile home parks considered kind of recession proof, right? Because if, people have to downsize, then this might be an obvious transition for them. I don't know. What do you think about that?
thanks for asking. I mean, definitely, it's just it's look, if when times are tough, if we all come down a notch in our lifestyle, and most people do, they ratchet it down a notch, I guess. If we have, when things are tough, well, if you want to own a home, I mean, we're the least, we're the most affordable option. We're the least expensive option out there. So we're at the bottom of the totem pole in terms of that lifestyle. And I always say, hey, in a good market, investing in mobile home parks is good. It's a great, it's a very good business. In a bad market, a recession market, it's even better. It's even more compelling, if I may say. because because of what we just talked about, being being the bottom of the totem pole.
Yeah, because you do well, and just people that are thinking about retiring and want to contain their costs, they're going to be living on a smaller fixed income and looking like, how can I do this and make it work? Plus, you've probably got some families that are just starting out, and or a lot of just working class people that are content. And the nicer you make the park, as far as the outside and curb appeal and things like that, that just makes them what I've seen from our other mobile home park clients is that once you establish that curb appeal, that people start fixing up their own units.
Right, and we have strategy to encourage that, to help finance that, make it possible for residents and or for those who want that, and really encourage it. So, um, but one, I think the other point that I should mention right here is that, look, this is a solution. The homes are so much better now today, by the way, and I think the politically correct term, in fact, is manufactured housing communities and manufactured homes versus mobile homes. There's been a shift in the industry. I should note that. So in these communities, if you want home ownership at an affordable price, and why do people lean towards a home versus, let's say, a lifestyle in apartments or condos or whatnot? And yeah, the key differences are, right, that you don't have an adjacent wall. You don't have a wall with a neighbor. You have a backyard. You could probably have a pet easily versus some restrictions otherwise if you don't own your home. Um, and you have many of the amenities that you would have otherwise in a nice subdivision. So there's true benefits that you can get in a manufactured housing community that you just can't at the same price point, that you're not going to get otherwise elsewhere. Um, and the homes themselves. I mean, try taking your stick-built home down the freeway at 60 miles an hour and see if it stays together. It's just, it's not going to. We can't even handle the earthquakes well out here in California, and God forbid if we hit a big one. But I'm just saying, these homes go on the freeways in sections, right? And so they're built, the quality, and even just the appeal now with island kitchens and eaves and just two-story. I mean, it's amazing the kind of stuff if you walked, and I have, onto manufactured sites where they have a stick-built home and a manufactured home next to each other, and people like myself who've been in this industry for a long time, and they asked us to tell them which one's which, which is this, Pepsi or Coke kind of thing, and many of us failed. We couldn't tell the difference between a manufactured home and a stick-built.
I've been in some beautiful parks, especially in California, where there were just lovely manufactured homes. And yeah, so it's no longer got the stigma, maybe because we've gone away from the mobile home park, where everybody just thinks of the single wide, and they don't think about these double wides and, in all configurations, like you said, with, upstairs and everything else that you can get
Right.
now. It's amazing. So yeah, maybe the stigma has kind of gone away from that a little bit, especially in a better maintained park. I went on a tour once with some guys that were buying mobile home parks, and we were in San Diego, and they took us to this park where I swear there was not a single mobile home in there that was older or that was younger than, say, 1975, and
Okay.
for like an immaculate condition, because it's just like people had lived there forever and it was in this premium location and they weren't going to give it up. And probably if you tried to haul that one out and bring a new one in, all of a sudden you've got all kinds of new rules, regulations, things like that, and it might not even be possible. So they just kept fixing them up, and it was like a step back in time,
Right.
amazing and
Yeah,
very
it's fascinating. Markets like that. We have a property down near San Diego as well, and in fact, it's one of the trophy properties I was mentioning earlier. But in any case, markets like that, you see the homes where otherwise, if they were anywhere else, if that same home might be in would have been in Bakersfield, like you said, a '70s model, maybe double wide, it wouldn't. Maybe it wouldn't be worth more than maybe 50,000 or so. But because it's in San Diego, because of the location, and particularly because of the rents being locked in some cases, the space rent, that is, the homeowners, in fact, benefiting from the real value of the location, right, as opposed to the community owner. That's a separate podcast, but I think those homes are valued at $400,000-$500,000 just because of their locations. To your point,
Well,
versus 50,000.
have you ever bought a park that was kind of outside the city limits where you had to have your own water treatment system, or do you shy away from those kinds of parks?
We shy away. We have done them. We've done septic tanks and wells and whatnot. It's not ideal, and for a number of reasons, the materials used, the wiring and the copper wiring and whatnot, the kind of things that the way they were built and the capacity, particularly electrical, but also like to your point, the sewer and water issues. Um, it, you know. It, there's just a lot more risk and management and cost when it comes to those areas, and so we definitely shy away. Not to say we won't or I won't, pursue a deal, but it has to be very compelling otherwise for me to overcome that hurdle.
Right, right. Well, Krisha, do you want to go ahead and tell people how they can get a copy of our books?
I do, yeah. Before we go there, I'm just gonna interject with my little 2 cents here. So Ali, what I heard there in the story that you told was that, obviously you come from a really long lineage there. So it was in your blood for a really long time. But then your father, like he had nothing, right? And so it's like, how do we make something out of nothing, right? And what I heard in that story was like that entrepreneurial spirit, that entrepreneurial journey, that hero's journey, even like he had nothing except the vision. He had that
Yes,
vision. He was so clear on that, like so clear that he told your mom, his wife to be. But then he just kept taking action. It was just like action, action, action. It's almost like the delusionalness that you need to be an entrepreneur.
right.
It's like which is just happening no matter what. Um, and that innate drive, but also like being super creative and that trial and error, just like not being afraid to fail, I think is a really big thing for entrepreneurs. Like, okay, you're going to fail, like things are not going to work out. Okay, dust yourself off, pick yourself back up, keep going. And then you guys really hit on a niche, right? Like, so there was like a clear goal and a clear niche. And this is like from everybody that we've interviewed, Kim, like this is what I keep hearing over and over and over again is the people who are super successful have had a clear goal and a really clear niche. And I just wanted to impart that, as part of like the wisdom that you've brought to this conversation from that perspective.
Oh, thank you, Krisha. Yeah, and when you said action, I couldn't agree more. But I just want to, I'd like to just add to that the action with taking risk, right? I mean, like you said, it wasn't. I mean, I think along with that, you have to be daring. The entrepreneurial spirit was there, but he was taking risk while having 7 mouths to feed, and
Yeah.
and maybe and beyond, right? So being willing to take risk despite the circumstances, I think that's also part of it. I think many of us hold back. We're afraid of that
Yep.
the risk and you have to overcome that as well.
Yeah.
Well,
You gotta just let it be.
mention a common thread that I've seen, and that is whenever we interview somebody that, was part of a family that immigrated to the United States, there's this, we're in the land of opportunity, how can we fail attitude, right? Like we're here, we had nothing, now we're just going to make it happen. And so let's just
Yeah.
go, let's get to it. And
Right.
a lot of us that are raised in the United States, we don't have that benefit. Even though it seems like it's like, why would that, that kind of a story benefit you? I think it does because we're, more cautious, we're more afraid, we're more fearful. We're like, oh, but what if? And then you could get sued and all these legal issues. And boy, it just sounds like such a hassle. So we don't necessarily have that just, I'm going to forge ahead and it's just going to happen. And so what if I lose it? I'm just going to do it again, and
Yeah.
I think that that's something that we all need to adopt is a little bit of that immigrant spirit, just like, hey, what would Ali do? Would he go forward with this deal or would he be like, oh no, I don't know. I might lose money. I might, you don't strike me as that kind of guy.
Yeah, and to be fair, I also was exposed to the same kind of risk or challenge of being not as ambitious or as motivated because I didn't have that was my father's struggle initially, right? And that was really his uh, position, and he had nothing to lose, right? That was his attitude. I'm going to go, and so I tried to capture as much of that as possible. I'm not as I don't want to claim to be as ambitious or as entrepreneurial as he is, or and still is. Yeah, thank God. But I think I'm close. And I think it's because I'm the next generation. I don't know that my son, by the way, or my daughters will be as much, because we get influenced, right? We all kind of have this mindset once when life is comfortable. But I hope we can pass that on and continue, because I agree with you, Kim. That motivation, that ambition, that you see many immigrant entrepreneurs. I think that's it's gold.
Yeah, it absolutely is. And so, I encourage everybody that's listening is that when you get to that point of indecision, think like an immigrant. Okay, what would I do if I came from absolute nothing and I had nothing to lose? And maybe that will help give you the courage to go forward when you should, and to
Right.
not back. So
And those what if fears just like never happen. Other things happen, but those what if fears, they just never happen.
oh, there's all kinds of things that could happen,
Yeah,
but you just live your life and you have to live it day by day, and you can't worry about everything that could happen tomorrow, or you'll never do anything.
never
And
agree.
a lot of people, so the naysayers in your lives, if you're experiencing that with some of your family members or your friends, they're the people that are afraid to move forward. So they do
Mhm.
not. They stay with their jobs, they stay with where they're comfortable, and then even then, look at, not that I want to bring political light onto this, but, we've got a whole lot of people right now who thought they had very, very secure positions, who are now, kind of forced to rethink that. Like, okay, what am I going to do next? I'm not going to have this position anymore. I need to, and I think there's going to be a big migration that results from some of these, current administration policies. But not all of it's going to be bad. And I think that for the people that are going through it right now, it probably seems financially devastating. But I bet if you interviewed a lot of those people 10 years from now, some of them are going to say, "This is the best thing that ever happened to me."
Yeah.
Some of them, maybe
Sure.
not all. For some people, it's truly going to be devastating, and we feel for them. But for other
Right.
people, they can seize the opportunity, and maybe they've been too comfortable, because you have
Mm.
to have the rug. My sister said this to me once. You got to have the rug pulled out from underneath you every once in a while, or you just
Mm.
get stuck in a rut. And once that happens, you're like, okay, now what? Now what am I going to do?
Yeah.
Pick myself up, go forward, do something else, do it differently, whatever it takes. And and that's how a lot of our clients got here. How they got to real estate investing is they looked into their future and said, yeah, this is comfortable, but it's not going to give me the lifestyle I want, long term.
Mm.
It's not going to give my kids what I want to be able to give to them long term. So
Yeah.
Makes sense. Absolutely. Yeah, it'll be
Well,
interesting to see how this unfolds, because I think you're right. There's some people will just be compelled to take advantage and focus on their strengths and take that risk. So
yeah, well,
good.
yeah.
and encourage them all to do that. Hey, so maybe we'll see some new real estate investors out of this. People that want to think about, well, okay, I don't really want to go work for somebody else. Maybe I can just turn what I have into something more passive. So we might see some more real estate investors, maybe some more active investors that come into this world and seek it as an alternative. Because we've definitely seen that. Whenever I teach an event, I always ask who's here because they want to augment their income, who's here because they want to retire early, who's here because they think their kids aren't going to be able to support themselves. Say, don't raise your hand if you're with you, right?
Yeah. For those listening, I mean, if you're going to hear a lot of discouragement, right, and there's going to be fears and whatnot, and I don't know, I've been watching a lot of improvement type videos and podcasts lately, and somebody mentioned the other day, if you're facing experiencing problems, 75% of the people around you don't care, and 25% hope you fail. So if you're going to, and that's maybe a very pessimistic view, but the point is that if you don't go to unqualified people, your friends, your neighbors, and whatnot, to seek out the advice. I mean, go to the lawyers, go to the experts. You get the right support, and just tune out all the other negative energy.
That's
Yeah.
why we created a clients only community for our group, and we do weekly masterminds there, which is kind of a gathering spot for all of our clients who are raising capital to talk about some of these things that are, causing them to hesitate, or, kind of getting this negative feedback, and how do we overcome that? And sometimes the answer is you don't try to overcome it, you just try to go somewhere else.
Right.
That's the wrong pond. There's no fish there. Go somewhere else and catch.
Yeah.
Right. So
Yeah. And like what I love about what we do is like, yeah, we have that spirit here, and we really encourage people to like have that like growth mindset and like that nothing to lose. But but there is a law or two that you need to follow, and because you need that, you need the structure, you need the thing to the thing, the structure, legal structure, and then you can play in that, you know what I mean? And because you are taking, if you are doing this in a passive way, right, you're taking passive money from people, you need to make sure you're doing it right, obviously, and follow the rules where that's concerned. But then once you've got that structure and that framework in place and you really understand it, then you can like, play and have fun in that, right? And our mastermind, like you mentioned, and Ali, you talked about our mastermind at the very beginning, about that community being so positive. But we also have like 2 books that Kim's written as well that I'll just quickly talk about, because raising capital, if anybody's on here wanting to raise passive income for any kind of deal, it is complex. There are a lot of like strategies and things involved. So if you're brand new to it, we do have this first book here, where you can learn about the basic strategies and laws involved in raising capital. And if you are, experienced like Ali, we do have more of a desktop reference here that you can go into more depth and detail about. Both of these books are available on Amazon. If you search up Kim Lisa Taylor on Amazon.com, you'll be able to find both of those books. The second one is also available on Audible. And if you want us to mail you a free copy, you just need to text the word syndicate, SYNDICATE, to our phone number, 844-796-3428. That's texting the word syndicate to 844-796-3428. And you can also head on over to our website as well. And you can learn about our mastermind through chatting with us as well by scheduling a call. And we're all, I need a cigar now. Like I need a cigar.
yeah, we made Ali move because we wanted better lighting, and he's now sitting
Right
at his
cigar bar.
table. Is this
My 14-year-old asked me the other day, he's like, Mom, have you ever smoked a cigar? And I'm like, I have actually.
Right on.
He's like, I
Right
could
on.
totally see him doing that too. He's like, sophisticated in that way.
It's the one vice that doesn't get you in as much trouble as anything else, and still makes you feel like you're doing something. And anyway, yeah,
Gee.
something
yes.
before the call that I thought was really brilliant? And you said, I don't sell, I let people come to me. How does that work?
Yeah.
So I don't know that it was a conscious decision originally, or I think it's just something that's innate or natural on my part, where I don't want to I don't like to ask for the sale, and I don't feel like I need to. Call me arrogant, call me a little, but I know what I know my business. I know when I see an opportunity, a deal, I know whether it makes sense or not. And if the deal makes sense, the money will come, right? And then it's also about, for me, it just works out where in my natural, my way of socializing, my way of engaging, you bring up the cigar. It's a community, like many other communities that I'm sure many people are involved in the audience, that are listening right now, whatever your community is. And in just natural conversation, or in some of these masterminds that I participate in, like yours, where I'm around like-minded people, when they ask questions and we have an opportunity to engage, and I have an opportunity to explain what I'm doing, I generally find people that are very curious, very interested, and want to participate. And that's why eventually, we have the family office and the family portfolio, which is, I should say clearly that that's a private entity that I'm only a part of. That's not exclusively mine, obviously, but separately created a fund. That's what RiseCom is for people who are, looking to be passive investors or semi-passive investors. And people will approach me all the time. Hey, I don't have the time to figure all this out. You've been doing this forever, whatever. And they have their questions. They decide, and they offer. They offer to participate, and then we'll see if it's a fit or not. But I don't go deliberately, clearly. I don't ask. It makes me uncomfortable, and I don't feel like I need to. There's no need for it. The money will come.
Yeah,
Mhm.
so, but I would put one caveat on that.
Okay.
That's not the case if you're brand new in this industry, because you have to cultivate a network of interested people who know you and know enough about you to know what you do. And once you get to that point, then I think you can safely say, hey, when I have a deal, so many people know what I do, and they've heard my passion and me talking about it over the years, that when I have a deal and, mention it casually, then they'll be like, hey, how can I get in? So, in the early stages of your syndication career, you really need to take the time to establish those relationships. Now, some of you may already have a potential base for those relationships. Find the people who are like you. If you're in the medical industry, then other medical professionals. If whatever. If you're a car salesperson, you've got other car salespeople. If you're in the military, start with your tribe, and then expand out from there. But start with the people that think like you, that know, the same industry you do, even if it's not real estate. And then those are the people you can have natural conversations with about, hey, I'm starting to do this, here's why. And but you also speak their language. So I think that's critical when you're developing relationships early on. So please, 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 we've seen people lose big coming to us with, oh, if I find a deal, the investors will come, because it's not true. What will happen is, if you find a deal and you haven't cultivated your own investors, you're going to end up giving away a whole lot of your deal to people who have cultivated relationships with investors. And you're quickly going to learn, gee, if I don't do this myself, I'm only ever going to get a piece of a deal. I'm never going to get the whole deal. So the people that have gone on, our clients that have started small, gone into bigger properties, or gone on and done many, many, many more properties, 3, 4, 5 a year. Those are the people that, had someone on their team that was good at raising capital, good at just talking to people, just getting out there, being social. So if you're not the social butterfly, you got to have someone on your team who is.
Thanks for making that distinction, Kim. And I couldn't. I mean, I just want to echo that, and agree wholeheartedly. The idea of being out there is important, right? The idea of networking, meeting like-minded people and other people who may not know the industry, but just just being out there, socializing, and having the opportunity to talk about what you do, I think is incredibly compelling, right? At any stage, really, but especially in the beginning, as you said. So I don't disagree with that at all. Asking directly for investment is something that I just personally, and maybe to a fault, maybe I could have scaled more or can scale more if I do that, but it's just not something that I typically have had to do for the deals at hand. There's been enough just by being out there, networking, socializing, etc., and people seeing what you do, and naturally just asking questions has led to to deals, to investment.
I remember hearing somebody on the news one time say, my brother makes millions of dollars taking people to lunch. So this is somebody who is in the finance world and probably raising capital, and all they were doing was inviting people out to lunch, get to know them, they get to know you. Naturally, the conversation talks about what you do, what they do. If you're having a great time, you want to hang out more, so you're going to figure out a way to keep the relationship going.
Thank you. That, in a nutshell, that's the model.
That's what I'm picking up here too, is like what we're talking about. We're talking about two different things. There's strategy and then there's a vibe. And the strategy is to get out there and develop relationships and, fill your hopper, right? But what's the vibe? And Ali, I think you're talking about your vibe is just, it's more relational, and it's coming from service. And been in business development for a really long time. And I think the reason why sales gets like a bad rap is that icky, sleazy, like, ew, you know, that car sales person or whatever, is because that person isn't coming from service. They're coming from like lack or scarcity, or like, come buy, you know, and that doesn't feel right for a lot of people. And so sales gets a bad rap for that. But if you're looking at business development or sales, or creating these relationships with investors from a place of service, it's like, hey, like, I really like you. I think, you know, you're cool, and let's smoke a cigar and blah, blah, blah. And oh, by the way, I've got this thing. And, you know, if you like it, that's awesome. You know, like it's a different sort of vibration that then people are attracted to, or they're not. And they're going to be curious, like, tell me more about this. Like, what is this thing? Oh, well, it's this mobile park and blah, 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 whatever. And then it creates a different level of interest from people, I think, rather than just like, hey, we've got this thing and we need money. And oh my God, like panic, or whatever.
That's right.
It's easy, like, I gotta make my commission.
Right.
You know, I gotta close on this deal. And to Kim's point, like, you need to fill your hopper so that when the deal is ready to close, you're not panicking, you know, and you've got that nice, like, you know, group of people that you can go back to and say, hey, we had a cigar together, you know, like, now we've got this thing. Are you in or out?
Right. No, you summed it up really well. I think it's about the vibe. And by the way, the vibe should be mutual, right? It's not just if they're feeling it. I mean, you should be,
Yeah.
ideally there'd be chemistry. But I think to Kim's point, you got to build, you got to be out there. You got to be networking. You got to be talking. You got to be meeting and lunches or whatever you want. But at the same time, I think if you're doing enough of that, hopefully you cultivate enough interest without actually having to, um, appear desperate, and you shouldn't be desperate. Ideally, because that doesn't work. That just, I think that does exactly the opposite of what you want to come, like you said,
They feel like,
come
why,
across.
with this deal, why are you chasing me?
Right.
So we do have a question
Yeah.
from someone in the audience.
Michael, are you buying MHP with mainly homes owned by the residents or rented to tenants? Also, what is the minimum C/C return occupancy IRR for potential acquisition? Oh, and then he wants to know what you're smoking.
Oh, let's start with the most important things first.
Easy question.
Yeah. I'm having a Monte Cristo. It's a great cigar for the mornings with coffee. It pairs well with coffee. It's a light cigar to start with, and a very reputable brand. So try a Monte Cristo sometime. And I already lost my focus. I'm so into the cigar topic, but so.
Home parks or manufactured housing communities that are mainly with homes owned by the residents or are rented to tenants.
So I mean, look, I particularly prefer home communities to answer the question that are owned by the residents. The homes are owned by the residents, and it's again a question of, what are your objectives? Do you want more immediate cash flow? Do you want more headaches and management? I see it from that perspective. Management intensive, more risk, more management, all those more investment in terms of eventually having to buy and sell homes or whatnot. So if you're looking for a real business to operate, then you might be fine with homes that you own, that are park owned, because you'll probably have a much higher gross income, and you probably have even a better better returns at the bottom line. But it's also much more risk and management intensive and all those things I just mentioned. I don't want that, right? So for me, I'd rather play the long game and have the nice stable income stream from the land, and not really engage myself in a going concern or a business. And if you want to do that, you might even consider apartments or multifamily or other asset classes that are more management intensive. The idea, the whole reason for being in the mobile home park business is that you have the opportunity to not have to take on the headaches of plumbing, electrical, et cetera, in a home. And because all you're really renting out is the land. So that's my preference. It's not everyone's preference. I've seen people make money on both sides, but it's just really about a mindset of what you want.
All right, we've got at least time, but we've got a couple more questions. What's the minimum cash on cash return, occupancy, or IRR that you look for potential acquisition?
So cash on cash, I'd look for, and thank you for asking that question earlier, whoever did, but cash on cash, 12 to 18%, is kind of the goal. By the time I exit from a deal on an average 3 to 5 year window, or 2 to 5 year window, I'm looking to be north of 22 to maybe 25%. We can still usually accomplish that. Cap rates, you want to obviously buy at a high cap rate and sell at a low cap rate. So I'm looking for 7.5 or north of 7.5 on the cap rate in acquisitions, and typically to be able to, for dispositions, to be at 4, 4.5, 5 in this market right now. And sometimes it's much better. I can be north of 10, by the way, and sell at 3.5 or 4. But at least 7.5 is where I'd like to 7.5 as a buying side, and selling at 5 or so,
And
or
that
less.
you really got to do some improvements. You've got to dress it up so that it, because it's not going to sell at those low cap rates unless it looks nice. And
That's right.
so, all right. So, Alex has a question. If you were to lose it all, start all over again in real estate, what's the one secret skill you would refine on, or how would you do it expeditiously?
Wow.
Great question.
It's a great question. I'm personally not in the fund, but personally, I'm doing a deal right now just to stay close to everything we just talked about, Alex. And I'll share with you that I'm doing a deal that's north of $10 million. We're trying to do a deal that's north of, I don't like the word trying. We're going to hopefully do it, right? We're going to do it. So I'm working on a deal right now that's north of 10 million, and actually around 12 million purchase price, with no money down. So I'm still, and I say no money meaning not no money directly from myself or any even passive investor. It's a creative structure. So I'm doing now as what I would probably be doing if I was starting over, right? And it's a creative deal, and maybe a topic for another conversation. But there are still ways. It's very difficult. I remember the late night talk shows or the real estate shows in the 70s and 80s where buy real estate with no money down, and a lot of that was almost impossible, but it was possible, and I think it's still possible today to do some deals that way. You just have to get incredibly creative. So I'm challenging myself to still try and do that in this market. So anyway.
We're a little bit over time here, so I want you to be able to share your contact info with people. And Ali was gracious enough to say, hey, if somebody out there has a deal and you'd like to get some advice, he's happy to share his knowledge with you. And I guess if anybody's out there that might be interested in getting to know Ali a little better and might be interested in looking at some of his future opportunities, then certainly reach out to him. So Ali, how would you like people to do that?
So the email address for me is ali@joinrisecom.com. The fund name is Risecom. And so Ali, ALI, at joinrisecom.com. And my phone number, if you'd like, is area code 650-492-8490. Again, 650-492-8490. And feel free to reach out. Thank you for listening.
In the chat.
It's been great. You are definitely the first guest that's ever smoked a cigar on our broadcast.
I think it should be a thing now.
I'm not going to apologize. I hope that's acceptable.
Don't
do the cigar. Okay. But I will say that in some of our prior conversations on our masterminds, Ali said, hey, that's one of my tribes. I invite people over, we smoke cigars, we play poker. You got to find your tribe wherever it is. And it doesn't matter if it's something you like to do personally or professionally. Sometimes it's better if it's things you do personally, because there's no pressure there. You're just there to enjoy each other's company, get to know each other better. And, eventually that's going to cultivate into to more prosperous opportunities for everybody that's looking for them, right? Some people aren't.
Absolutely.
Those that are,
absolutely,
you'll gravitate together. You'll find a way to work together if you like to hang out. So awesome. You guys are great. Love the audience. Thank you so much, Krisha, for your valuable input. And Ali, we'll look forward to doing another deal with you.
Sounds great. Thank you, Krisha. Thank you, Kim. Appreciate the opportunity.
Thanks, guys. Thanks, everybody. We'll see you on the next episode. Bye.
Okay. Bye-bye. Bye.
Bye.